everybody. My name is Maurice Button. I'm the CEO of City and Financial Global, and welcome to the latest in our series of speaker interviews. I'm delighted to be joined by Tom Godwin, who's a partner at Freshfields Brookhouse Derringer, and Tom is going to be speaking at our Future of UK Capital Markets Regulation Summit in London on the 25th of September. Welcome, Tom.
Thank you, Maurice. Good to talk to you, and great to pick up on some of these themes ahead of the summit.
Fantastic. Let's turn to the first question. Following the announcement of reforms to the listing regime, Nick O'Rathy said that the reforms would significantly rebalance the burden of regulation to the benefit of listed companies and investors who are willing to set their own risk appetite and terms of engagement. Do you agree that the reforms will have this effect?
Well, broadly, yes. I think that the changes in large part amount to a realignment of the regime to a much more disclosure-based approach, certainly to eligibility and to an extent to continuing obligations on listed companies as well. I think particularly the removal of a requirement for a 3-year revenue earning track record will open things up a little bit. Loosening of independence and control requirements will allow a significantly broader group of issuers to look at the new single segment. And the goal does seem to be to provide a simpler, more accessible listing regime for issuers and a wider range of investment opportunities for investors that as you say, and as Mr. Arthur said, are willing to engage with it. As to whether that rebalancing will be beneficial to issuers and particularly companies perhaps that are already listed and their investors, the change to the regulator's approach raises a few questions, clearly, that it will be interesting to see how they play out. How will that disclosure-based approach in London be policed? In the US, exchanges, as is often talked about, have a similar approach, and there is obviously a very active plaintiffs bar in that jurisdiction around those exchanges that tests that disclosure. I think companies and boards know that there is a chance, if not a good chance, that key disclosure on their sort of material transactions, things like that, have a chance of being tested in court at some point. We've seen a rise in the UK of firms building shareholder claimant practices and bringing those sorts of claims. So perhaps that is the direction of travel. Maybe the regulator will need to be more active in testing historical disclosure after the fact. But I think there may also be a feeling that the FCA will need to be relatively light touch after changing their approach in this way, in sort of quite an immediate way. So it'll be interesting to see how that happens. And then will investors and asset managers obviously see this as beneficial? And that maybe is the big question. And it does seem to depend on who you talk to an extent. We hear a lot about the investment community being much less parochial, much more jurisdictionally agnostic, global even, and in our experience that does seem to be playing out with the base of new issuers and IPO candidates as well, who are more able and willing to look at different exchanges when they're coming up to an IPO point. So from that perspective, it clearly makes sense to put London, from a regulatory perspective, at least on an even footing with exchanges in Europe and the US, as these reforms are looking to do. The flip side, I suppose, is that London's gold plating of investor protections, coupled with the FCA's relatively pioneering, I think at the time, sandbox approach, was historically seen as a benefit and certainly a differentiator for London, with a particular benefit for some of the sectors that were popular in and regarded London as a popular destination for listings like finance, energy, and resources in particular. So it'll be interesting to see whether going head to head with some of the other exchanges on a similar basis of regulation is net positive.
Yeah, that will be very interesting, won't it? I mean, that the removal of the sort of premium listing concept, which had been a great asset to London. But, you know, the counterbalance of all these changes and the benefits they bring, you know, hopefully, as you say, sort of broadly, they'll be very much for the good. But obviously, the change to the listing rules is only part of the broader set of reforms. As we've seen, there's a drive to encourage greater investment. And various task forces and review bodies have been looking at other changes that can be made in respect of accessibility and quality research, digitalization, accelerated settlement, etc. So, you know, across the piece, what difference do you think collectively all these things are going to make?
Well, I think I certainly agree that a wider review of the ecosystem for the capital markets is the right approach. As you say, it's only part of the story to make a change to the rules. And these are the sorts of systems, as you say, that in some areas of those reviews anyway, should be kept under development, certainly. I think to some extent, those are areas in which good housekeeping is needed. And perhaps we're at a point of natural evolution where technology is now available to provide greater efficiencies in those areas, and I think I would think of digitization, accelerated settlement probably in that category. You know, 3-day settlement was a necessary evil when paper settlement for orders was needed, and that came down in some instances to T+2. And you know, if the technology is there to improve efficiencies further, then that would be a natural progression, and I think is an important thing to happen alongside. You know, thought about improving accessibility to the market. Probably the slightly different one in that range of reviews that you mentioned is the UK Investment Research Review, which I think is slightly different in that it is looking to tackle a key issue, not just for the market in London, but in lots of markets, being the deterioration in the amount and quality of market research. And I think the way that review is targeting that problem is a very good one in that it's probably mostly about unconnected research at IPO and looking at the impact of not just the changes from MiFID II, but the other COBS rules that the FCA brought in, which I think will be helpful to reevaluate that a little bit, but possibly even more importantly for ongoing research for listed companies and not just SMEs that are getting the majority of the attention, but I think the quality of research for the larger listed companies. That ongoing research is a very important part of the information available to the market. It supplements, or rather it allows companies to supplement it with their own comms and to refine market sentiment. The unbundling of payments for research and trading in MiFID II, while intended clearly to increase transparency for investors, I think it's no secret has decreased the amount of available research in a deterioration that started before that. And some of the recommendations in the IRR will help put the UK on a more even footing with other exchanges that have either never moved towards that unbundling or have moved back to it, like the US again. And I think that could be very helpful practically, to come back to your question, for issuers and investors. It should help to set a more accurate and nuanced consensus in the market, and that allows issuers to refine that further with their messaging. So ultimately a better informed marketplace.
Yeah, no, I agree with everything you say there. What further moves do you think the regulator needs to propose to make a difference? Or is it really the willingness of companies to list here? Is that driven by something else, do you think?
Well, on other things that the regulator might think about, I think these reviews, I would say, just as a starting point, have been sort of brilliantly open-ended, and there has been some great kind of breadth of thought and willingness to act in different ways across the piece. More narrowly on the changes to the listing rules that are proposed, I think on the eligibility requirements, it's going to be important when these rules are actually put on paper for the regulator to avoid their new single segment and the other segment that is still being mooted, forming really just a rebranded premium and standard. And I think that happens by completing the picture on the removal of some of those more difficult eligibility requirements, like some of the remaining parts of dual class share structures that are still looking like they'll be outside the rules. I think that could be difficult for certainly some of the larger companies on the standard segment now. But perhaps the flip side again on continuing obligations for already listed companies is that some moderation would be helpful, certainly in the context of things like related party transactions and the rules that govern companies with major shareholders. And reform in those areas has been plentiful and sometimes quite quick to react to market factors. So I think retaining an element of fair and reasonable reporting on things like that, it is a helpful level of investor protection that does not disenfranchise particular parts of the market from coming to London. And on whether this will do the job, I think for some IPO candidates, the current rules are an impediment. Companies that have a highly diversified business or franchise models or are pre-revenue or all sorts of things that are talked about a lot struggle with the London rules, and there are just less law reasons why they can't access it. But I think for the majority of businesses that don't fall into those smaller categories, looking at listing venues, willingness to look at London is driven by other factors. It's no secret, particularly that executive remuneration is at a very different level here than it is in other countries. A number of these reforms, through the regulation, are clearly targeting, growth sectors like tech and life sciences that has ever been on a big in places like the US. And there's a clear understanding that those proposals that those companies are founder-led often. So London needs to be aware that you can make the rules available for those sorts of structures, but if you are not viewing REM and other things in the same way as other markets, then that is a bigger problem. So I think those rule changes will be very helpful, but as you say, Maurice, is only part of the story.
Yes, I mean that you mentioned remuneration, and that's something which doesn't seem to have been discussed very publicly, at least during this debate. But perhaps it is one of the most important issues. That if you're a technology entrepreneur and you want to do well from all your hard work, and you can list in the US and have a very high salary and bonus, which is sort of culturally unacceptable in the UK, that does tend to steer you towards US markets or other markets. Do you think?
I think that's right, and I'd go a step further in saying that that those sorts of founders will be looking for the best people to help them take their companies forward to the next step, in a public market forum. And it isn't just the founders that produce value for those sorts of businesses. Once they're on the market, clearly their growth is important, and we know that because sometimes they come to market when they're still pre-revenue. And having the best people available and properly remunerated in a competitive way to do that is important for the market too.
Yeah, very good. Well, that extremely interesting conversation, Tom, and thank you very much for sharing your thoughts on that. We look forward to discussing all these issues and many related ones at the conference, the Future UK Capital Markets Regulation Summit, which is being held in London on the 25th of September. And we very much hope that the people viewing this interview will be able to join us in person at the event. So it just remains to say, Tom, thank you very much.
Pleasure. Thank you, Maurice, and see you there.